In case the spot Bitcoin ETFs didn't give it away already, asset managers such as BlackRock are extremely bullish on crypto. Another asset manager that's bullish is Fidelity, which is almost as big as BlackRock, and they recently published a report where they analysed BTC and ETH's prices and where they could be headed next. So, in today's video, we're going to tell you what that report says and what it could mean for the crypto market. The report we'll be summarising today is titled, quote, Q1 2024 Signals Report, and it was published by Fidelity on the 22nd of April. We'll leave a link to the full report for you to check out in the description. Now, the report is basically split in half, the first half for BTC and the second half for ETH. Before getting into the meat of the report, the authors add a note that crypto analysis doesn't only use traditional market signals, but also on-chain analysis. They add that choosing the right signals can be challenging, and that this report aims to gather the most reliable indicators. So, the report begins by discussing Bitcoin's short-term measurements. For reference, the report notes short-term to be anything up to 1 year. Anyways, the first metrics discussed are BTC's 50-day simple moving average, or SMA, against its 200-day SMA. The authors note that the 50-day SMA has remained well above the 200-day SMA, maintaining the golden cross that played out back in October of last year. In case you weren't sure, a golden cross is when a short-term moving average passes up through a longer-term moving average from below, which typically signals many green days ahead. The authors note that while the 50-day average was tested throughout January, the price remains around 15% above it. To their credit, they note that this could be a level where we see some significant pullback. And this has already played out because between the day this report was published and the day we're shooting this video, BTC has fallen by over 15%. Safe to say they got that one spot on then. With that said, the authors point out that BTC's price has, quote, maintained a healthy gap between itself and both the short-term support level of $62,700 and $43,343. Well, with the 62K level now out of the window, we'd better be keeping an eye on that 43K support. Not financial advice, of course. What sticks out, though, is the chart which shows a clear pattern in the 50-day SMA. As you can see here, the last two rallies look eerily similar, and we saw a pretty sharp pullback on both occasions. As the saying goes, history doesn't repeat, but it does rhyme. Now, the final short-term indicator to look at is Bitcoin's realized price. For reference, this measures the average cost that holders paid to obtain their BTC, which the authors note is around $28,000. Obviously, this means there's plenty of people in profit, which signals a high incentive for some profit taking, driving prices down. What's strange is that the report lists this as a positive thing. Now, don't get me wrong, everyone loves a bit of profit, but nothing goes up forever. When those profits are being taken off the table, not everyone will be feeling quite so bullish. To be fair, though, the authors do make a good point, saying, quote, retracements may be short-lived if demand outweighs selling pressure. And I think it's fair to say that demand isn't going away anytime soon.
Alas, poor Yorick. I knew him, Horatio. A fellow of infinite jest, of most excellent fancy, he hath borne me on his back 1,000 times. And yet, for all his vitality, he kneweth not of the Coin Bureau deals page. Where are your 60% discount on trading fees now? Your exchange sign-up bonuses of up to $60,000. Wherefore art thy discounts on hardware wallets too? If thou hadst only beheld the link in the description below, how thou wouldst have marvelled at these riches. Alas, poor Yorick. I knew him, Horatio.
Okay, now the next section of the report looks at Bitcoin's midterm indicators. For reference, midterm refers to anything between 1 and 5 years. There are quite a few midterm indicators in the report, so for the sake of time, we'll just cover the more influential ones. But you're encouraged to check out the whole report if you want to see all of them. The first indicator Fidelity look at is the Net Unrealized Profit-Loss Ratio, or NUPL for short. The authors state that, quote, historically, this metric has been an effective assessment of overall market sentiment. As the name suggests, this gives an idea of how many people are sitting on unrealized gains against portfolios in the red. A score below 0 signals that most people are sitting at a loss, usually marking a capitulation zone. A score above 0.5 signals that most people are in profit, indicating an imminent pullback. The report notes that BTC's Q1 position sits between 0.5 and 1, floating around the belief denial zone. Normally, this would be concerning, but the authors note that catalysts such as the halving and the spot ETF inflows could cement Bitcoin's position. Now, the chart provided shows a few interesting things. First, it shows that the euphoria phase becomes shorter and shorter with each cycle. You can also draw almost perfect support and resistance lines. As you can see, whacking these on suggests we've already hit the top and are about to see a reversal. Time will tell if that plays out or not, but to be fair, this seems unlikely given those ETF inflows. Anywho, the next indicator the report looks at is the MVRVZ score. Basically, it compares the market value, i.e. the current price, with the realized value, the price of each BTC when it was last moved around, to determine if we're at fair value or if we're at a market top or bottom. The authors note that the MVRVZ score climbed along with BTC's rally from 44k to 70k. They add that they believe BTC is still in a healthy position because, quote, the incentives to take profit here are not extreme. This can be clearly seen on the chart provided, which suggests we could still have plenty of room to run. However, the authors also caution that a continued rise throughout Q2 will likely see more profit taking. Next is the stock-to-flow deflection, which measures the ratio between the current price and the traditional stock-to-flow model. A ratio of 1 or more means Bitcoin is overvalued. Anything less is undervalued. The authors comment that the stock-to-flow model is becoming less relevant due to BTC's decreasing inflation rate. Nevertheless, BTC has been considered undervalued since 2022, according to this model, with an expected BTC price of $117,000. Not bad at all. Now, next up is the Puell multiple, named after its creator, David Puell. This indicator compares miner profitability to the previous year. The authors note that miner profitability is a whopping 80% higher than last year and that selling will realize them more profits. They highlight the previous halvings on the chart provided, pointing out miners will lose 50% of their revenue if prices don't go up. They add that transaction fees since Q4 are, quote, significantly lower. However, if you watched our recent Runes video, you'll note that Bitcoin fees actually hit new highs, which you can see clearly here. I'm pretty sure miners weren't complaining on that day. And by the way, you can find that Runes video in the description. Anyway, next, the report looks at the net position change for hodlers. This metric reveals that a lot of hodlers started selling more of their BTC as prices hit new all-time highs. The authors state that BTC hitting an all-time high pre-halving is unusual, and as such, investors likely believe BTC to be heavily overvalued. And this ties into the final indicator, which is the percentage of BTC addresses in profit. Now, this is probably the most bearish indicator of this entire report because it shows that over 99% of all Bitcoin addresses are currently in profit. Now, that is a lot of potential sell pressure. Weirdly, the chart provided shows that the profitable address count is now in the warning zone, although there's no mention of that in the report itself. Come to think of it, this could even be a sign of bias on the part of the authors. Okay, now on to Bitcoin's long-term indicators. For reference, long-term refers to anything over 5 years. The first metric is the monthly address count. The report notes that by the end of Q3 last year, the number of active addresses had surpassed the 1 million mark for the first time since June 2021. However, there's been a dramatic fall since then, which the authors attribute to reduced excitement around BRC20 tokens. They also note that the demand for block space has fallen, but speculate that, quote, this will likely not be the last we hear from the high fee and high transaction environment, and that we could see new protocols being delayed. Again, this points to the Runes protocol we recently covered, which I'll remind you can be found below. Anywho, the next metric observes the momentum of new addresses by measuring the 30-day SMA against the 365-day SMA to gauge on-chain activity. The chart provided shows that current active users are quite a way under the yearly average. Interestingly, the authors note this as negative, but depending on your perspective, this could be seen as bullish AF. That's simply because the lack of new users is why we still have potentially a lot more room to run. And if the current user activity has already pushed BTC to new highs, then, well, who knows how high we'll go when retail does come flooding back in. The next indicator observes how many addresses hold more than $1,000 in BTC. Since the beginning of 2024, the number of these smaller addresses has grown by 20%, reaching an all-time high in March of almost 10.7 million addresses. This could be seen as a sign that retail is starting to creep back into the market. The following metric then looks at the balance of BTC on exchanges, which has continued to decrease since its peak in 2020. To the author's credit, they acknowledge that this is due to the collapse of major exchanges, notably FTX. They add that this pushed more people to self-custody their own assets before casually plugging some Fidelity alpha. Quote, some custodians, such as Fidelity Digital Assets, are working towards allowing clients to custody their Bitcoin while simultaneously trading through an exchange venue. Again, we always recommend self-custody above everything else, but still, this could be big news if true. And finally, the report ends its BTC section with a special mention of the halving. The authors briefly explain the halving, highlighting that the new daily supply increase of BTC has fallen from 900 BTC to 450. They acknowledge that many investors dispute the halving's effects on the market, even stating that some analysts argue that the reduction of new BTC is too small to matter anymore. The caveat is that because most BTC is being hodled rather than being traded freely, the slightest of changes to BTC's supply will have a significant impact on price, assuming, of course, that demand stays the same or increases. Being as it's quite clear that demand for BTC is ever growing, it's fair to say that mining rewards really do make a difference. Okay, so that wraps up the Bitcoin section of the report. Let's now take a look at Ethereum. The first thing the authors observe about Ethereum is a positive shift in fundamental metrics post-Denkun. They state that the price of ETH has been in an uptrend since it formed a golden cross in November 2023, a month after BTC. And by the way, if you want to learn more about how Ethereum changed following the Denkun upgrade, check out our video all about that, linked to below. The authors then note that the gap between the 50-day SMA and the 200-day SMA has been widening ever since, with the price difference being around $1,000. They add that, in previous bull cycles, this difference hasn't been sustained for more than a couple of months, and that the recent pullback from the 4K mark could signal a reversal back to the longer-term average. The next short-term metric is Ethereum's realized price. According to the report, ETH's current price sits about 93% above the average price paid by investors, signaling that a lot of people could potentially take profits. However, the authors also say, quote, unlike Bitcoin, Ether's unrealized price has not yet reached the levels seen in the 2021 bull market, signifying that investors believe there may still be some room to run in the shorter term. Translation, ETH hasn't hit its previous all-time high yet, so this is bullish. The thing is, though, it might not be as straightforward as that. That's because of two things. Firstly, BTC has already managed to hit its all-time high, in large part thanks to the ETF inflows. ETH, on the other hand, doesn't have a spot ETF, and there's growing consensus that it won't be getting one anytime soon. This ties into the second reason. While ETH has been performing well in dollar value, it has been struggling against its BTC pair since December 2021. Therefore, we can't really be at all sure that a new all-time high is coming soon. Anywho, the next section looks at ETH's mid-term indicators. The first one is the Nupal that we saw earlier, and this one paints a similar picture. The authors acknowledged that ETH has been in a prolonged state of fear, but had entered the belief phase by the end of Q1. If we draw support and resistance lines similar to the ones earlier onto ETH's Nupal chart, you'll see that we're almost at a resistance level, and that ETH's support level is climbing much quicker, indicating a much lower rate of volatility over time. The next indicator is the MV/RVZ score for Ethereum, which I'll remind you measures the ratio between market cap and realized cap. According to the report, ETH is currently at fair value. The authors note here that despite Ethereum's impressive run throughout 2024, ETH is actually leaning towards the undervalued end of the fair value scale. However, they also note that the metric inherits the volatility of the price, and that this could bring ETH into the overvalued range very quickly. The next metric looks at the percentage of unique addresses in profit. Notably, this metric hasn't touched the bottom indicator since January 2020, which the authors say, quote, may be because Ether is not necessarily considered a buy and hold asset. This is true unless you fall into the ultrasound money camp. Anywho, the authors observe that the percentage of addresses in profit sits at 91%, which, similar to BTC, should be seen as the most bearish of all indicators. However, the authors also speculate that investors are hodling until ETH hits a new all-time high. And finally, for ETH's mid-term metrics, we have the Pi Cycle Top indicator. Now, if you've been keeping up with our good friend Ben Cowan, you'll probably have seen this one before. The Pi Cycle Top has historically been a good cycle top indicator. It works by taking the 111-day SMA and comparing it against a 2x multiple of the 350-day SMA. You know, because, well, maths. Anyways, the report explains that this metric signals that we don't seem to be hitting the cycle top just yet, which suggests that the earlier theory of a run to new all-time highs could have some merit after all. So, on to ETH's long-term indicators. The first thing the authors observe are monthly address metrics, specifically new and active. They explain that the number of new addresses grew by 39% in Q1, while the active address count rose by 25%, with a 12% climb in monthly transactions. The authors again attribute this to the Denkun upgrade, with a lot of activity happening on bridges and decentralized exchanges. This ties into the next metric, which measures the transaction count on Ethereum Layer 2s to determine the success of Denkun. The authors state that while Layer 1 transactions grew by 12%, transactions on Layer 2s have soared by more than 74% since Denkun. They add that this even exceeds their expectations outlined in a previous report, which suggested that Layer 2 usage would climb, while the Layer 1 remained stagnant. The chart provided clearly shows that transactions have seen a significant increase since Denkun was finalized on the 13th of March. And this ties into the next metric, which looks at Layer 2 submission fees. Basically, it looks at the amount of fees a Layer 2 pays to the base layer when submitting transaction batches to be verified. This metric again shows just how successful Denkun was, because Layer 2s are paying significantly less in fees despite processing far more transactions. Notably, the authors explain that Layer 2s were typically paying 500 ETH a day to submit transactions before the upgrade, but are now paying just 100 ETH, an overhead reduction of 80%. The authors note that users are also paying 80% less in fees on average, And looking at the chart shows that these costs seem to be more stable than they were previously. Now, the next metric is the number of stakers and validators. The authors start by explaining that while the validator number has been rapidly increasing since the merge in September 2022, we are starting to see this growth slow down, with a total of just under 1 million validators by Q1. The authors also draw attention to the chart that highlights the changes to the tighter cap on the number of validators allowed to join at any given time. Interestingly, the number of active validators dropped sharply after Deng Kun's implementation to levels akin to mid-2023. Also observed is the number of validators who have exited the network, resulting in no real change in the total validator count since January. The authors state that this is bullish from a developer standpoint, as it allows them more time to consider proposals to adjust the ETH reward curve to align with the staking ratio. And finally, the authors look at the net issuance and burn rate of Ethereum. Since the merge, ETH's supply has decreased over the long haul, making ETH a deflationary asset. As basic economics dictates, a reduced supply combined with the same or more demand means number go up. The report notes that Q1 contributed significantly to this burn, with a daily burn rate of 14,000 ETH in early March. It's also noted that with the reduced limit in the maximum number of validators, this should, in theory, make it easier for more ETH to be burned than issued. And with that, we've reached the end of Fidelity's report. So then, what does all this mean for Bitcoin and Ethereum going forward? Well, there's a few things we can decipher from this report. The first is that Ethereum appears to have a much more bullish future than Bitcoin. With increased deflation, a string of successful upgrades, and an all-time high firmly in the scope of investors, there does seem to be a lot more room to run. The main obstacle, though, for ETH is, well, BTC. While ETH has performed well in dollar terms, quite frankly, it's been struggling against BTC for far too long now. Yes, BTC had the recent ETF approvals, but ETH has been lagging for well over a year, long before the ETFs were front and center. Also consider that Ethereum is becoming ever more dependent on Layer 2s to operate, who themselves have started to use Layer 3s to remain scalable. Not only does this show that Ethereum is less reliable as a base layer, but there also seems to be less fee revenue as ETH's liquidity is fragmented across multiple blockchains. This could potentially be offset by ETH demand on the Layer 2 level, though, as ETH is still used as the primary asset for trading and things like DeFi. However, it's Layer 3s that could quickly become a sticking point. That's because each Layer 3 is application specific, which means they don't require nearly as much ETH for gas fees in order to handle DeFi, collateral, or even meme coins. And by the way, you can learn more about Layer 3s in our recent video. The link is, of course, in the description. Not only this, but Bitcoin also has its own Layer 2 ecosystem, which is starting to grow pretty quickly. If this rate of growth continues, it won't be long before Bitcoin starts absorbing users and capital from Ethereum's ecosystem. With that said, though, there's no denying that Ethereum is one of the most robust blockchains out there. And let's not forget that the Ethereum ecosystem accounts for a huge portion of the overall crypto market. As the bull market continues to gather pace, Ethereum's demand will likely run on rocket fuel, particularly when we hit altcoin season. Combine that demand with ETH's deflation, and you could well be onto a winner. And if you're wondering when altcoin season could finally be here, check out our video on just that, linked to below. And that's all for today's video, folks. So if you learned something new, let us know by smashing that like button. If you want to keep learning, then be sure to subscribe to the channel. And if you want to help others learn, then take a second to share this video with them. If you're looking to trade BTC or ETH, then be sure to check out the Coin Bureau deals page. It has trading fee discounts of up to 60% and sign-up bonuses of up to $60,000 on some of the best exchanges, as well as discounts on some of the best hardware wallets for you to store it all on. So be sure to take advantage of these limited time offers before they're gone. The link is, of course, in the description. And with all that said, thank you all as always for watching, and I'll see you in the next one. This is Guy, over and out.